Stocks and bonds dropped as Powell pulls the support from the market and the Fed goes into full inflation fighting mode. I'm your host, Steven Van Metre, and thanks for joining me today as both stocks and bonds were down as investors faced a more hawkish Fed when they were hoping that after a big drawdown in stocks, that the Fed was going to come to their rescue and that Powell was going to pull a dovish pivot. But with inflation running at 7% from this time last year, the Fed is in trouble, and President Biden and Congress have both tapped Fed Chair Powell to get control of inflation. And with that, Fed Chair Powell said the end of accommodative monetary policy is over. Let's head over to Bloomberg, who headlines Powell backs March liftoff and will rule out rate hikes at every meeting. The FOMC said interest rate hike will soon be appropriate and the balance sheet reduction to commence after liftoff begins. The Federal Reserve Chairman Jerome Powell said the central bank was ready to raise interest rates in March and didn't rule out moving at every meeting to tackle the highest inflation in a generation. Quote, the committee is of mind to raise the federal funds rate at the March meeting if conditions are there to do so, Powell told a virtual press conference today, while noting that officials have not made any decision about the path of policy because it needs to be nimble. In a separate statement, the Fed said it expects the process of balance sheet reduction will commence after it has begun raising rates. Powell said no decision was taken at this meeting on the pace of the runoff or when it would start. And this is a big difference from what everyone thought. They were hoping that with stocks down, that Powell would back off. And from what it looks like, he's pushing on the gas to get out of this accommodative monetary policy. Let's keep going. The hawkish pivot against a backdrop of turmoil in stocks comes amid consumer inflation readings that have repeatedly surprised and hit 7%, the most since 1980s, and a tight labor market that's pushed unemployment down faster than anticipated to almost its pre-pandemic levels. The yield on the 10-year Treasury note rose sharply as Powell spoke while stocks fell and the dollar pushed higher. Now, this is really interesting because everyone expects that if the Fed raises rates, that yields should rise. Now, remember, quantitative easing was supposed to cause interest rates to go up, and you heard all the experts and the bank CEOs talk about interest rates could and only should go higher, and they didn't. Well, now that we have a taper and potential rate hike, well, that story and narrative is back. And is it true? Well, not really, but let's take a look. And here you can see 10-year Treasury yields driving higher as the market's starting to suggest that interest rates must go higher. But will they? Well, probably not, because there's a demand component to the story that many people are missing. When you have a higher interest rates, you have to have demand from people who want to borrow at them. And last week, mortgage applications fell 7.1%. Now, you may recall we've talked about this and how people have already refied or purchased at rates that were below where they're at now and are unlikely to refinance at higher rates. Well, that is a bit of a problem for all these higher interest rate story. In fact, we can go back now and look at the monetary base when the Fed previously started to unwind its balance sheet and compare the 10-year Treasury yield and the federal funds rate. And here we can see that the Fed started to raise rates as they were unwinding their balance sheet, and the 10-year Treasury yield went down. Now, what's really important for you to understand is interest rates are a function of future growth and inflation expectations. And so right now, for some reason, people believe that interest rates have to go up because growth and inflation expectations are likely to rise. And so what you're seeing is speculators shorting and selling bonds to drive interest rates up in hopes that there will be demand for those rates at higher rates in the future. But what happens when the Fed tightens is actually the exact opposite, is growth and inflation expectations begin to fall. And that's why you'll see the bond market, even there days like today where it sells off, reverse direction and go up, and yields will go down because the economy will dramatically slow. And you can see that in the chart here. There's periods where interest rates were falling, they got pushed back up, bond route, and then all of a sudden went down, and that's what's likely to happen again. The quote, the tone of Powell's press conference is hawkish, said Neil Dutta, the head of economic research at Renaissance Macro Research. The Fed is going to be much more willing to hike faster in the face of upside inflation surprises than ease in the face of downside employment surprises. And that's correct, because Neil, you should be asking yourself, what's going to happen here? Are these higher rates from the Fed going to tighten conditions or ease them? And remember, Fed Chair Powell has previously told us the whole purpose of this was to pull back on demand, was to constrain it. If you pull back on demand, what happens to the economy? It slows down. and that's why interest rates fall. Let's keep going, because here you can see the job opening story that the Fed was peddling today and said, look, there's all these job openings, but Powell cited the reason people aren't working is due to COVID and family-related issues. And there's a lot of truth to that, but perhaps there may not be any jobs, but he was expecting the labor force participation rate, or the percentage of people who are participating in the labor market, to go way up. And so when faced with the question of, can interest rates go up and you tighten policy and still maintain a strong labor market? And he said, absolutely we can, because look at all the job openings, and when COVID goes away, all these people are going to come back to work. And that was what he believes. Let's keep going with the story, because now the Fed suggests its balance sheet to shrink via roll-off, not sales. And you may recall last time the Fed unwound its balance sheet, well, that was bad news for stocks. But one thing it shouldn't be bad news for is your portfolio. If you haven't checked out Portfolio Shield, be sure you do, because it was designed to deal with these type of volatile markets. Let's keep going with the story, because the last time the Fed undertook so-called quantitative tightening from 2017 to 19, it set monthly limits on how much it would allow to roll off without being replaced by other securities. This time around, there's been speculation that it might need to actually sell assets at some point, although the newly released principles suggest they are inclined not to. And here you see eyes on the balance sheet as the Fed said it'll opt for runoff and outright sales. This chart from Bloomberg showing the last time they did this. And of course, we know that that brought interest rates down as financial conditions tightened, and the Fed emphasized that it sees changes in the Fed funds rate as its primary means for adjusting monetary policy. So going forward, the Fed is going to lead by raising the federal funds rate and then letting its balance sheet unwind. Let's continue on, because it said that in the longer run, it tends to mainly hold treasuries in its portfolio, currently holds both treasuries and mortgage bonds. Now, you may recall that the mortgage bond part of the Fed's balance sheet has been assigned with causing home price inflation. Well, that's a problem for the Fed too. And if that means the Fed's going to pull support there, well, guess what's going to happen to home prices? If that is true, that means home prices are going to go down when the Fed unwinds its balance sheet and gets rid of those mortgage-backed securities. But the real issue we should all be watching, if you missed the show from late last night, is the volatility index, because if volatility screams out and breaks out, the Fed's not going to be there to stop it. And the question then becomes, who's been the marginal buyer of equities? Well, you can see here from this chart of monthly net purchases of U.S. equities by individual investors. It's all been based on retail flows. And without retail investors buying, there isn't support under the market. And without the Fed supporting it underneath that, well, you can only guess where the market could go and where volatility is going to head. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only. It's not intended to provide an investor in other advice. Zero not to be construed as recognition or solicitation to buy or sell any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity. Opinions expressed in this video that do not affect the value of Atlas Advising or Steven Van Metre Financial.